Special purpose acquisition companies, blank check companies are all the rage. Billy Bean's got one. Even former House Speaker Paul Ryan has got one. Here are you, though. He's a former executive with Oracle and Dell, and he recently launched his second tech SPAC. This one focused on online gaming with his venture partner, the former chairman of Glue Mobile, the company that brought you Candy Crush. And now, our very own Ed Hammond spoke exclusively with you to discuss what kind of targets this new venture is going to be looking at. Take a listen.
We're trying to avoid hits-driven businesses, right? So parts of mobile gaming is like the movie studio business, and we're really going after mobile manifestations of great brick-and-mortar businesses that will be transitioning, especially here in the pandemic, like Rush Street.
And as I mentioned, you've gone public with the second SPAC this week. You've already done another one. There are, it seems like a welter of SPACs being raised every day and being talked about every day at the moment. Is it starting to feel a bit sort of frothy in the SPAC space?
Well, it's just, if you call it frothy, Ed, the activity is clearly there because of the zero interest rate environment, all the uncertainty. And if you think about it, it's a fascinating, I would call it the revenge of the retail investor. Because when I look at our recent example with Rush Street, it's a fascinating case study of where if we had done a traditional IPO, Rush Street would have been very, very successful. It probably would have taken them longer to get there. But the retail investor would not have been able to participate until the very, very end, until the IPO itself. It'd be the last couple of weeks. And then the typical retail investor would be clamoring to their broker and getting a de minimis amount of shares. But in the case of Rush Street, we've announced last week, the slides and management presentation came up. The proxy's going to come out in a couple weeks. And then there will be a final roadshow to solicit the shareholder vote. So there's this nice period, healthy period of 2 to 3 months. And the institutional investors like it as well, Ed, because instead of if you happen to be at the butt end of the roadshow, you might literally have an hour to decide whether you want to put in an order with your friendly investment bank. But now you can literally have weeks time to meet the management under a non-disclosure agreement. So in a way, that is what has propelled this move towards the SPAC structure. I think a lot of it is just getting more time, issuers or sellers knowing that they have more certainty that a deal is going to get done. But it's wonderful for the investors because they have a lot of time to ponder and think about things.
But Harry, let's talk quickly about the retail investor there, because that is a big part of this story. As you say, it allows them to get in at the front door and not wait until the company is listed. But isn't there also a concern that potentially retail investors don't really know what they are getting into with a SPAC? And at least with a company going public through the traditional methods, there's a lot more access to information that they can have.
Actually, the information is quite good, Ed. So in the case of Rush Street, we have the management slides up. You would never get those in an IPO till the bitter end. So those will be around for 2-3 months. There's a webcast presentation. And then there's the comfort knowing in the better reverse merger transactions. In ours, for example, Fidelity is a significant PIPE investor. So you know that big institutions have looked at it. Fidelity's coming in at the same price as a retail investor would. So, you know, you feel that there is the sponsorship. But of course, like everything else in investments, Ed, one has to be diligent yourself and do all your own work. But there is a chance as a retail investor to do the work.
Big picture, Harry, you spent a long career in the technology area, worked with significant number of big global technology companies. We sit at a moment now where you have these sort of daily increasing tensions between the West and China. Obviously, that has huge ramifications for the tech space. And indeed, you're on the board of one of the first companies to become sort of ensnared in this new moment of corporate nationalism, Broadcom. What do you think the outcome is here? And I suppose more particularly, which companies are going to emerge stronger from this current moment of tension?
You know, it's hard to predict who will do better other than the generic statement, Ed, that the more sort of nimble and adept. But, you know, what I'm always reassured by is, you know, when there are these cyclical upswings in political tensions, I think the business people across the globe will do the right thing for their shareholders and their self-interest. And I see a lot in terms of my particular experiences that people will try to adjust. But I think it will affect supply chains and how people might think of risk in the future, where they domicile factories, what key linkages they have in the supply chain that they want to mitigate the risk on if political tensions flare up further.